records. Yep. Okay, we got it.
Excellent, thank you. Good morning, everyone. My name is Aaron Oberg, and I am the Director of Finance, or whatever it is I do. Director of Finance, I think is the title. And I'm glad that you could join today. I just want to start off with introductions of who else is on that call. Uh, Carolina, Paul, Kelly, do you want to introduce yourselves?
Okay. Good morning, Carolina Navarra. I'm the assistant to Gina, to the Chief Financial Officer.
Good morning, Kelly Bergstrom here, two-term Finance and Audit Committee member, and happy to be here.
Good morning, Paul Prody, member of the Finance Audit Committee as well, my first term.
And our first thing on the agenda is to turn this over to our financial advisors because we're going to go over the particular monitoring report related to our investment policy and making sure that what we're invested in meets both our own policy and our policy essentially mimics state law and what it is we can invest in. So I'm going to turn it over to Delana and Corey. Corey, are you presenting? And if you both want to just introduce yourselves and then go ahead and share your screen, and we can, if you're presenting a presentation, we can get started.
Excellent. My name is Corey Gable, portfolio manager at Public Trust Advisors. Have been managing the school district's portfolio for the last, I guess, 7 years. I'll turn it over to Delana so she can introduce herself. And also, Delana, can you share your screen? Does that work?
Yep, absolutely. Thanks, Corey. Good morning. Delana Gross. I am the relationship manager and investment advisor at Public Trust Advisors. And I've been working on this account for almost as long as Corey has. I inherited it from a previous colleague, but recognize a few names on here. So it's nice to see you all again. And Paul, it's nice to meet you. And let's see, let me pull my screen up here.
Well, okay. Delana, thank you, Delana. And while you do that, I thought I'd give you guys a quick just update on the economy, financial markets, and then get into, as Aaron had mentioned, the investment policy statement, how we're meeting the standards that are outlined, and then also a quick update through the portfolios. And so the economic themes are listed here, and they've changed certainly a little bit, even since the end of last month. And we've never, I've been doing institutional fixed income for now 27 years. And I've never experienced the wild ride that the Federal Reserve has put us on as it raised rates, from basically 0 up to 5.25% to 5.5% on the lower and upper bounds of the Fed funds target range to fight inflation. Inflation in the summer of 2022 had peaked at 9.4%. Now we've trended much lower into the to the 3% levels. And so now the Federal Reserve is likely done raising interest rates and has been since September. But the real issue and what's causing more volatility in the market, even over the last couple of weeks, has been, have they stopped too soon? Inflation has seen a resurgence. The economy is doing very well. And so that is causing some organically natural inflation to pop back up. And so that last mile of getting inflation from the 3s down into the 2s, which is the Fed's target, has been very, very difficult. And so at the beginning of this year, everyone thought the Federal Reserve there's about an 80% probability based on what the market thought that they would be lowering rates in March. That did not happen, obviously. And they had subsequently 5 additional cuts to the Fed funds rate priced into the market for 2024. Now, even that has been pretty volatile. Now it looks like there's about 1 to 2 cuts priced in by the end of this year. So you can just see the significant change in thought process regarding the Federal Reserve and what it's looking for, and it's looking for better data, and we're waiting for that to happen from the inflation numbers. The employment market has been on a tear, which I'll get into. All of those things are leading to the Federal Reserve to put the brakes on everything, just kind of standing in the middle, high center, and waiting for a guide to determine if they potentially need to do any additional hikes. We don't think so. We think that they've pushed rates high enough, but they could certainly push cuts certainly down the road, which they've done even with Powell's commentary yesterday. So, with that being said, though, the financial conditions have been very, very good, as you can see here. Financial conditions as measured by the overall levels of the stock market, which recently hit all-time highs, credit spreads, volatility, overall level of interest rates. Above zero means financial conditions are very good. Below means they're worsening or not good financial conditions. And as you can see, we've kind of reached this near-term high as it concerns financial conditions, and that's impressive considering the overall level of interest rates are significantly higher than they were when we're back at these levels. When the Fed had taken us to zero for Fed based on conditions with the pandemic. But the stock market has a lot to do with this, and we're already up over 10% year to date. And so looking at rate cuts, this has been very volatile, and this was done on March 28th, and things have changed significantly. I mean, we could basically throw this out now. Right now, if we look, what this is telling us is this is based on the Fed funds curve, the market's curve, in anticipation of what it thinks the Federal Reserve will do. And over the next several meetings, and you can see when this was done, June had about a 70%, 69% probability of their first cut to the Fed funds rate. Right now, let me pull up my Bloomberg terminal. Right now, that's zero. And so that's changed, obviously, pretty significantly. Also, the trajectory or the pace of cuts has also declined. And so right now at the December 18th meeting later this year, there's 1.65 cuts of 25 basis points currently priced in. We had 3 2 weeks ago. So that's been cut in half, certainly, as you can see here. Overall, though, the Federal Reserve is watching the data to determine when they need to implement and get rates lower to provide economic stimulus. They are in a restrictive stance with overall level of interest rates, certainly currently. But the one nice thing is the Federal Reserve does raise rates, so they have the ability to lower them. And we certainly have lots of ability to lower rates pretty aggressively here. One thing that we talk about on the trading desk is certainly as the Federal Reserve was raising interest rates, it didn't raise at 25 basis points, right? It started out at that level, but then it jumped up to 75 basis points per meeting. And it certainly could lower rates much quicker than 25 basis points if it needs to. Looking at the ISM data, the Institute of Supply and Manufacturing gives us a good gauge of the surveys coming out of both manufacturing and service industry companies. And the ISM Manufacturing Index, which was released at the beginning of April, showed that we're back into the expansionary phase of the business cycle. We had gone from 47.8 back up to 50.3, which for manufacturing is beat all expectations. And it's the first time we got back into the expansionary phase since September of 2022. And we're seeing this sharp rebound in production and stronger demand, which is leading to kind of a resurgence of manufacturing, which is fantastic. After 16 straight months of shrinking activity, it was welcome news. The service industry came in at 52.8, which is kind of right in line with the previous number, and it's held up much better. Consumers traditionally shift from goods consumption to service consumption in more higher inflationary environments, and we saw that certainly in this latest one. Looking at inflation overall, as I mentioned, inflation, this is the key linchpin driving the Federal Reserve's investment policy or investment strategy as it concerns the Fed funds rate. The inflation is certainly, as I mentioned, peaked out in the summer of 2022, and this last mile of inflation has been the problem. As you can see in the blue line, we've kind of been trending between 3 and 4% on inflation since then. And, you know, we thought that, you know, we would be continuing that trend lower, but this last leg is certainly the problem. And we're seeing, I think, Americans be, you know, relatively pessimistic or down on the economy overall. And I think a lot of it has to do with, you know, the grocery store prices, cell phone costs, gas prices, all impacting what we're seeing from the price of goods and the changes of goods. And so that is certainly playing a role in why American confidence or American, you know, optimism is very low, because those items are certainly impacting everyone. So the service industry, we're seeing autos, insurance, et cetera, all run higher, especially the insurance side segment. And so really, what is the rush for the Federal Reserve to raise rates when things have come down, but not to the point where they've you know, certainly hit the low point. All of this has meant that, you know, Treasury yields off the curve have been higher, with the 2-year Treasury now kind of bouncing around 5%. And so, as you can see, though the headline numbers shelter, we've seen the top line be less volatile. This is housing and rent costs, and you can see that that's come down, but is now starting to flatline based on the latest 2 CPI prints. And then, you know, even services, you can see the light blue is now starting to trend higher. So ultimately, more work to do on inflation. Employment wise, as I mentioned, has been probably the bright spot of our economy. We've seen the U.S. economy add jobs anywhere from 275 to 350,000 jobs a month over the last 4 months, which has been fantastic. The unemployment rate's been below 4% for the last 25 months. We're at or near the record of 3.4% unemployment, and we're a very tight labor market. So this gives the Federal Reserve the ability to wait, because where employment goes, usually the economy goes. And as you can see, the economy is very, very strong. Treasury yields have been very volatile since the beginning of this year. You can see yields have bumped up anywhere from 30 to 40 basis points across the yield curve as that Federal Reserve horizon and when they start cutting rates keeps getting pushed out. And so you're seeing yields stay elevated, which is good for portfolios like yours, and being able to collect that higher income, certainly. And so, you know, finally, kind of to wrap up, the Fed's in this waiting game. They need more data and more confirmation that inflation is not going to resurge and you know, take a step in the wrong direction. That has kept them in this, you know, waiting game, watching the data as it comes through. The economy has been very, very good. I was looking at the forecast for first quarter GDP growth are right around 2.4%, which is fantastic. And so, you know, not even, you know, I think it's going to take some time and some confirmation from the Federal Reserve. They're going to give us good guidance on when they're going to cut, in my opinion. So it's likely in the second half to maybe even the fourth quarter of 2024 before that likely happens. But we can certainly hang out in this Goldilocks scenario with strong economic growth, strong employment, inflation, which isn't too bad considering the near-term highs that we've hit, and overall higher level of interest rates. can, hopefully last for a little longer before things ultimately cause some sort of systematic break. But overall, at the beginning of this year, we had increased our duration. We're kind of in this boat now where we're more neutral duration positioning. Any questions on the portfolio, or I'm sorry, the economic kind of current state, or anything on the financial markets before I flip into the portfolio?
Kelly, Paul, Christina, feel free to unmute and jump in at any time if you have questions. And go ahead, Christina.
Well, I was just going to say thank you. I will.
Excellent. So let's go ahead and keep going, Corey.
Yeah, excellent. So reviewing the to Aaron's point, the big part of this is obviously making sure that we're meeting the investment policy statement guidelines, also Colorado revised statute as it concerns investment of public funds, and we're certainly doing so. We're meeting all the asset allocation requirements, which we can see here. Also credit rating requirements, maturities, etc. Asset allocation wise, the column to the farthest to the right, second from the right, shows our current positioning. What's allowable and maturity max is on more the left-hand side, but we're at 26% in U.S. Treasuries, 4 and 3% in agencies and corporate bonds, 5% of municipal bonds. And the biggest thing is local government investment pools, which account for about 60%. And so because liquidity is taking up the biggest portion, which it should, based on the goals of safety, liquidity, and yield, that's really driving the rest of the allocations lower. But overall, nice mix of all of these asset classes, providing good diversification. Looking at the general fund portfolio listed here, very diversified portfolio. On the upper right-hand side, you can see the mix of securities changes over the last year. We've added 1% to corporates. Municipals have not really had any changes in allocations, currently maintaining about 13% in this portfolio. U.S. Treasuries have increased by 7%. From 59 up to 66%, and U.S. agencies are down 8%, down now to 11%. And the reason is U.S. agencies are not paying us relatively a good spread over U.S. Treasuries, and so we've seen us have the portfolio become a little more conservative based on the market conditions over the last year. As you can see in the middle section, the portfolio statistics, we went from 2.48 years duration down to 2.39. Yield has gone up by 50 basis points from 415 to now 464. Similar on the book yield has gone up 120 basis points from 1.8. Now we're at just over 3% in book yield. So good returns, high quality portfolio on the upper left. All securities rated AA- or better, with 88% of the portfolio rated AAA. So in January of this year, we met with the committee and moved to a more, we had been a 1 to 5 year investment strategy, meaning as securities approached 1 year, they were reinvested and kicked out the ladder. Based on liquidity needs and potential liquidity needs, we've changed strategies to a 0 to 5. And so you see duration rolling in. We haven't been reinvesting maturities. We haven't had a lot of maturities, frankly, and don't expect any until this fall. But we will continue to kind of get a more conservative stance as it concerns liquidity. And so with that being said, unless there's a change to that strategy, we're going to continue to let maturities roll to cash and down the curve. Looking at the next portfolio is the 2018 bond portfolio, about 7.7 million, all in local government investment pools. Similar with the bond redemption, about 60 million, all in cash or cash and cash equivalents, not in cash, but in local government investment pools, which are now yielding, close to 5.5%. So really good place to be for those securities. as well. So, and unless the the strategy or the time horizon for investment is more than 2 years, we would recommend continuing to hold funds in these type of vehicles on the front end of the curve to pick up that highest yield. So, any questions on the quick update on the portfolios, investment strategies? Kelly's giving me a thumbs up.
Great.
Excellent. Yeah, we'll look forward to continuing on the investment strategies we discussed in January. If in the event that anything changes to those strategies, please let us know.
I just wanted to share with the group two different things. One, to piggyback off of what Corey talked about, as far as our overall investment strategy, moving more toward liquidity in our general funds. We may be able to adjust that. The General Assembly passed a new measure this year, which is now going to straight line our cash flow needs. Traditionally, our cash flow would come in the latter half of the year, the latter half of the fiscal year, meaning in March. Yep. February, March, essentially it's March, May, and June when the majority of property taxes are collected. What the General Assembly bill does is it straight lines that and front loads more of the state funding that we would receive, so that instead of having sort of a hockey stick approach to our cash balance continuing to go down into January and February, which we're nearing, I won't say that we're nearing zero, but we're nearing zero more in our 100% liquid funds. And then we would bounce right back up in the 3 months in which we collect property taxes. Now that the majority of that money will now come in straight line, we'll be working with Corey and Delana to look at some different strategies to maybe move it back to a 1 to 3 to 1 to 5 strategy, depending, once we understand where CDE is putting us in our cash flow strategy. So cash flow drives almost all of what Public Trust Advisors is able to do for us. And as our cash flow continues to potentially improve based on this new bill, we'll be able to maximize more of our investments. The second thing that I would say, just as far as Public Trust Advisors go, and then Colo Trust as well, and Delana, you may want to share the relationship there. But when we talk about Colo Trust as a public investment pool, the other thing that we want to also make sure everyone understands is where we're limited also by statute in where and which banks we're allowed to invest our bond redemption, not bond redemption, our bond, no, bond redemption. I'm sorry, our bond redemption proceeds. So when we talk about bond redemption proceeds, we are talking about banks that have been approved by the state to be trustees of public funds. So believe it or not, there are banks in which we could put liquid cash, meaning our checking account, etc., but they do not have trust departments, and they are not approved by the state to hold trustee funds. So I want to make sure everyone sees that difference when Corey mentioned the bond redemption proceeds and why some of that is liquid. and also that it is in a trust. It is specifically in trust, and the two county treasurers in directly deposit the bond redemption proceeds, meaning the district does not even touch the bond redemption proceeds, and it goes directly into a trust for principal and interest payments on our debt. So just want to make sure everyone is aware of what that means for our portfolio overall. It is not to say that we are 100% limited. I mean, we're limited in the trust departments in which we can utilize. And as Corey mentioned, knowing for sure that we have somewhat liquid investments so that if we choose to refinance our bonds or pay down our bonds early as we look forward to a potential new offering in December and January. So I don't know if I cleared that or did that make sense, Delana, on how I was describing that?
Yes, yeah, you hit the nail on the head very well. Very, very well described. Yeah, thank you for explaining that, Aaron. And if there are any questions on that, we're happy to discuss forward. But yeah, essentially the funds at the custodial trust are swept into Colo Trust so that you have the ability to earn the Colo Trust interest while maintaining the trustee or custodial relationship as required by state statutes for those funds.
Then in our general fund, so everyone is aware, we also have a decent amount of funds available that we were able to put into higher yield investments. And those are being held and managed by public trust advisors, both at through vehicles at Colo Trust and at US Bank, and all of which are part of this overall umbrella and part of this overall investment strategy. So when it comes, and we'll, after this presentation, and then we'll continue to work on the monitoring report. But before we say thanks to PTA for this presentation, just want to make sure if there are any questions before we move to the next topic.
This is Kelly. No questions. This has been super helpful. Thank you guys for explaining.
Yeah, no questions for me either. This is pretty consistent with my organization and kind of how we go about our quarterly meetings as well. So appreciate it. Thank you.
Great. All right. Well, thank you, everyone. If anything does come up, please don't hesitate to contact either one of us.
Thanks, Delana. Thanks, Corey. Thanks for the
Have a great day, guys.
Thanks, and bye-bye.
Great. So now we're going to move into looking at 5C. 5C, as you'll recall, is the latest mill levy election, and that was part of the Elevate strategy. When Elevate was put together, the community working with the board identified specific areas in which we would utilize the 5C proceeds. And so we'll switch now to a preview of that presentation. This presentation will be given to the board by the FAC in May. I think it's a May 1st meeting. I believe that's correct.
Yes.
So, of course, we're always looking for volunteers. I think we have one volunteer, but we need maybe one or two more. So as we walk through the presentation, and of course, I've put the bare bones of the presentation together. If there are pieces of the presentation that when we present to the board or when FAC presents to the board, if we want to provide additional information or if you want me to look for additional information to include in the presentation, then certainly we can do that. So I'm going to start presenting now. and sharing my screen around the overall mill levy presentation. So one moment.
Aaron, I'm sorry, are we still recording?
Yes, we are still recording.
Okay, thank you.
And Carolina, can you see the presentation? Okay.
Yes,
Okay,
yes.
great. So we always start with a leveling of what 5C is and what the purpose of it was. Certainly as it passed, and we've looked at ways in which we invest and make investments in our overall educational purpose. These were the groups of priorities that came out of Elevate. There were 6 of them. I think at the beginning there were 9, and through community work, board work, etc., that was then created down into six overall investment priorities. And the other piece around Elevate is just to continue the 5C accountability, where through FAC, we want to ensure that how we're utilizing these proceeds amongst our overall general fund. So again, the proceeds of any MLO come directly into the general fund. And as we put those funds into the general fund, we want to make sure a portion of that general fund revenue is put to these priorities. And we'll just go ahead and walk through the year-to-date spending and what we've been doing here. So as we first talk about 21st century learners, talking about technology, learning materials, district level, reducing district level student fees. And this allocation is currently 3.3 million. And I want to also address 5C, the mill levy. This particular mill levy is the only one of our mill levies, the only one of the 5 that grows by inflation. The other ones are set dollar amounts. So while this one began as a set dollar amount, it has increased by inflation every year. And that's Colorado-based inflation based on the Denver Aurora Lakewood CPI, Consumer Price Index, as opposed to the overall national inflation. And generally, I could share a slide with you, but generally, the inflation that we've seen in Colorado has been higher than the overall inflation rate as a nation. Here, we're continuing to track 2.9 million over 3/4 of the way through the year. We're already at 87% spending. As you might imagine, it's pretty easy to spend funds on technology devices and systems as we've moved more and more toward a 4 to 5 year replacement strategy on all devices of the district. So that would include student devices, and it would also include staff devices. And so utilizing at least some of these funds, $3.3 million, to update technology devices and learning materials, resources, etc. Obviously, when we start talking about textbooks over the next few years, we're now talking more about curriculum. And so we may need to look at that word textbooks as we continue to move forward and adjust it to curriculum because it includes electronic materials. And as textbooks become more electronic materials and as opposed to our literal books, then that has been adjusting as well. One thing I would point out here, as I would on every slide, is $3.3 million is not enough to cover all of the investments that the district makes in technology. So one way of how I would think of 5C is that we would never go below this spending amount of money. That doesn't mean we're not using additional general fund resources to pay for these. I think sometimes what you might hear is when you create a ceiling or you've created a floor, you've also created a ceiling. Meaning once you've said you're going to spend 3.3 million on these these three priorities, then that's all you spend. And that is most certainly not true. What that means, and so nothing that we do where the minimum sets the ceiling. So this is just a portion of the district's overall investment in these priorities. Same thing with diverse learning, where we've put 34% of the allocation of these funds. We're through the master agreement and through other agreements with the teachers and how we staff our buildings, that we have been able to continue to reduce class size. And remember, this was a priority in 2018. So this is a continuation of the work that started in 2018. To say this a different way, we're not able to reduce class size every single year, meaning we wouldn't have enough money, as you can imagine. This is only growing by inflation. It isn't growing, it isn't doubling in such a way that we would now have 22.4 million and we could continue to double and reduce class sizes that way. This is an initial investment in reducing class sizes. So I hope that is clear, because when we talk about staffing or when we talk about pay or investments in FTE or pay, that those then, I won't say set the ceiling necessarily, but in a lot of ways it does for the purposes of 5C, because we can't further reduce class size. We need this amount of funds to maintain the reduction that we started after the 2016, after we did the last mill levy. So hopefully that makes sense. If it doesn't, I want to make sure that that's clear. Part of this also, and this is required by state law, but even before it was required necessarily by state law, we were sharing proportionately with our charter schools, so that overall, not just this portion, but of the entire allocation of 5C funds, we share that proportionally with our charter schools. Part of expanding preschool is to make sure that we have preschool classrooms available. As we've moved to universal pre-K state funds are insufficient to cover our investment in preschool. So again, this is one of those instances where we have universal pre-K funding coming from the state, but that investment is not sufficient, which also means that this investment of 14 FTE to expand the preschool is not sufficient enough to run our entire UPK offering. So this plus the amount of money we receive from the state, those two things together are still insufficient at this time. So there are additional general fund monies that are allocated to preschool. And we're on track. If you think that we're 3/4 of the way through the year, we would generally be somewhere around 75%. But our teacher contracts begin in August, so there's a 1 month delay of the amount of money that we're spending. So 71% would be right on track. When we talk about CTE programming, that initial investment was 8% and has now grown to 2.6 million. This is a little bit over what I would say is where we would see spending at this point in time. We do have covering at least now a portion of the 29 FTE. There were funds available in the original fund balance, so the carryover of funds that had yet to be spent. So part of how we're able to utilize those 29 FTE and being above the overall allocation is that we were relying on unspent proceeds from the prior year. The fourth piece is safe schools. We continue to have the campus security officers that fund at least 10. Again, this is at least 10 utilizing these proceeds as well as other general funds. And those, as we've done access cards, as you can imagine, a lot of that was one-time spending, and then being able to utilize any of the further proceeds to do any replacement of facility access cards that we need to do on a continual basis. The fourth is SEL, or social emotional learning. Here, I would say, is one of the more direct pieces where this mill levy really expanded the programming that we were able to offer that maybe necessarily we weren't offering in a way that was this visible. So in utilizing that 4.7 million for SEL, that includes both expanding a curriculum around SEL and a crisis response team, but also staff at elementary K-8s middle schools and counselors at our high school. Of course, we had counselors at the high school already. What this allowed to do is to add a counselor at all of our high schools. So being able to utilize these funds around SEL to supplement what we were doing, and I would say dramatically expanding what we had previously been doing and continuing to spend these funds on this staff and ensuring that we're maintaining the extra counselor at each of the high schools. This is the last one, and this is world-class staff was, and again, not that these are in any, certainly not in any particular order. I think they're in alphabetical order. Here, increasing the salary and compensation, experience credit, the 1% cost of living, etc. Now, I do want to emphasize again that we were able to do the cost of living adjustment when we initially began the program. So what the $9.6 million allows us to do is maintain that 1% cost of living adjustment. Again, this amount of money doesn't provide a 1% upon a 1% cumulative year-over-year increase, because right now we would have been at 7% cost of living adjustment. That would cost substantially more than 9.6 million. So what this does is the initial investment of the 1% cost of living adjustment and the continual resources allow us to maintain the cost of living adjustment that had previously been given. This is important because, again, it stepped up the 1% COLA at that time. It doesn't mean then that became the only cost of living adjustment that we ever gave, because we've given cost of living adjustments through our other general fund resources since that time. And this just allowed us to do a one-time bump at that time of 1%, as well as increasing those salaries and compensation pieces. Again, that was just a one-time bump in that compensation structure. And what the $9.6 million allows us to do is partially pay for the continuation of that salary increase in these particular investments. Of course, we've utilized other resources to increase compensation beyond where it was when the mill levy passed and when we began receiving funds for the mill levy. The last piece is just really the overall. Here we've prioritized investment, the budget of where we are now, 32.2 million, and we've done expenditures of 25 million. We would have an ending fund balance of where we would continue to reserve a fund balance of 6.3 million. One of the reasons that shows up is where we're reserving fund balance. As you can imagine, anytime that we're talking about curriculum, we're not doing a curriculum adoption every single year. So having a fund balance and collecting a fund balance and holding over that fund balance, it allows us then to utilize resources periodically as we need a much larger investment in order to cover the cost of the overall curriculum. That's the presentation that we're proposing that FAC would do. Traditionally would go over any of these slides and maybe delve in deeper to any particular area that interests FAC more than the other, in ensuring that we're sharing that with the board. So happy to discuss the presentation now and any changes or additional information you want me to research to include prior to FAC presenting to the Board of Education on May 1st. Well, Christina, Kelly, this again is probably quite similar to the presentation that was given last year. And so it is kind of not a repeat, it's just a continual update and continue to have FAC emphasize where the district is spending these funds. So I'll just stop
Paul,
there.
can I ask a question?
Sure.
Did you find that last year the board had a lot of in-depth questions that they wanted follow-up for with the presentation, or was it more like just receiving information that was already somewhat familiar to them?
Paul, do you remember either way last year?
This is Kelly. Christina, no, there really wasn't a ton of questions asked or anything like that. It was more just, like you said, familiarity or presentation of the information that they're already familiar with. I didn't recall a lot of questions.
Okay, great.
And
I
wasn't
go
part
ahead,
of it
Paul.
last year, so I honestly don't know.
Okay, great. I heard the same thing from Gina, that there weren't the significant. This was more of a presentation to reset and reground the board on what it is we're utilizing the mill levy proceeds for.
Yeah, no, it looks great.
Okay. So we'll go ahead and